$1 million. Every single second. That's how fast money was vanishing from Silicon Valley Bank on March 9, 2023. Picture this. While you read this sentence, another $1 million just disappeared. Another million. Another. By the time you finish this paragraph, $10 million will have evaporated from one of America's most celebrated financial institutions. $42 billion. Gone. In 24 hours. Not in a war, not in a natural disaster, not from criminals hacking into the vault, but from terrified customers frantically tapping their iPhone screens, desperately trying to move their money before the unthinkable happened. This was not your grandfather's bank run. There were no Great Depression lines stretching around city blocks, no frantic crowds pushing against wooden teller windows, no panic screams echoing through marble hallways. This was something far more terrifying. This was silent. This was digital. This was invisible. And it killed a 40-year-old bank in 48 hours. You think you know what happened to Silicon Valley Bank? You probably heard the headlines. Maybe you saw the talking heads on cable news pointing fingers at woke banking or reckless tech bros. But here's what they don't teach you in the sanitized news segments in the politically charged Twitter threads. The real story of SVB's collapse is a thriller wrapped in a tragedy, starring billionaire investors, desperate immigrant founders, government officials making impossible choices at 2 in the morning, and one CEO who thought he could control the narrative until the narrative controlled him. This is the story of how the 17th largest bank in America died faster than any bank in history, and if you think this couldn't happen again, you're about to discover why you should be very, very worried about where your money is sitting right now. Let's go back to the beginning, not to March 2023, but to a time when Silicon Valley Bank wasn't a cautionary tale, it was a fairy tale. The year is 2019. The world doesn't know what's coming. There's no pandemic, no lockdowns, no Zoom fatigue, and in the gleaming towers of Santa Clara, California, a bank that most Americans have never heard of is quietly becoming the most important financial institution in the technology ecosystem. Silicon Valley Bank wasn't like your local Chase branch. It didn't advertise on television with smiling families buying their first homes. It didn't have ATMs on every corner. What it had was something far more valuable: trust. Absolute, unquestioning trust from the people building the future. If you were a 25-year-old engineer who just quit Google to start a company in your garage, and you walked into Bank of America with your pitch deck and your dreams, you know what happened? They laughed you out of the building. No credit history, no revenue, no collateral, no chance. But Silicon Valley Bank, they understood. They got it. They knew that today's broke founder eating ramen in a cramped apartment could be tomorrow's billionaire disrupting entire industries. For 40 years, SVB had bet on dreamers, and those bets had paid off spectacularly. Their client list was a who's who of tech royalty: Pinterest, Shopify, Roku, thousands of startups that became household names. Picture the Santa Clara headquarters in those golden pre-pandemic days. Glass walls reflecting the California sunshine, young founders in expensive sneakers and casual hoodies walking through lobbies that felt more like tech incubators than traditional banks, the smell of artisanal coffee wafting through open-plan spaces, bankers who actually understood what Series A and burn rate meant. This was a bank built specifically for people who wanted to change the world. At the helm sat Greg Becker, CEO since 2011, a career SVB man who worked his way up from commercial banking to running the whole show. Becker was the kind of executive who could command a boardroom and also grab drinks with founders half his age. He was optimistic, charismatic, connected, and he believed with every fiber of his being that the good times would never end. In 2018, Becker did something that would come back to haunt him. He personally lobbied Congress to roll back regulations on mid-sized banks like SVB. The argument was simple: we're not too big to fail, so don't treat us like we are. We don't need the same stress testing capital requirements as JP Morgan Chase. We're responsible community bankers who know our customers. Congress agreed. The regulations were loosened. And Greg Becker returned to Santa Clara, triumphant. Now, you might be thinking, what's wrong with less regulation? Banks need flexibility to serve their customers, right? And you'd have a point. But here's the kicker. Those regulations existed for a reason. They were designed to catch exactly the kind of problem that was about to detonate inside SVB like a financial time bomb. But we'll get to that. Then came 2020, the pandemic. And everything changed. When COVID-19 shut down the world, something strange happened in Silicon Valley. Instead of apocalypse, there was abundance. Suddenly everyone needed technology, remote work, online shopping, digital payments, streaming entertainment. The sectors that SVB served weren't just surviving the pandemic, they were thriving beyond anyone's wildest imagination. Venture capital firms, flush with cash and desperate for returns, began throwing money at anything that moved. The numbers were staggering. In 2020 alone, VCs invested over $130 billion in U.S. startups. In 2021, that number exploded to $330 billion. Money was cheaper than it had ever been in human history. The Federal Reserve had slashed interest rates to nearly zero to save the economy from COVID collapse. And all that easy money had to go somewhere. It went to startups. And those startups deposited their venture capital millions into the only bank that truly understood them, Silicon Valley Bank. Think about that for a second. You're SVB, and suddenly you have a problem most businesses would kill for. Too much money. Your deposits triple from $61 billion in 2019 to $189 billion by the end of 2021. That's $128 billion of new deposits in just 2 years. Cash was flooding in so fast that the bank could barely process it. But what do you do with all that money? You can't just let it sit there. In banking, idle money is a death sentence. You need to put it to work. You need to earn returns for your shareholders. You need to invest. And this is where Silicon Valley Bank made the decision that would destroy them. If you've made it this far, you're about to learn the fundamental truth that nobody in business school wants to admit. The safest investments can be the most dangerous. Let me explain. When SVB received all those billions in deposits, they had to do something with the money. They could have made loans. Traditional loans to businesses and individuals, the bread and butter of banking. But here's the thing about loans. They're risky. Borrowers default. Companies fail. And SVB had a specific clientele. Startups were statistically more likely to fail than almost any other type of borrower. So SVB chose what they believed was the ultra-conservative path. They took that flood of pandemic cash and bought government bonds. Treasury securities, mortgage-backed securities guaranteed by the federal government. These weren't risky subprime mortgages like the ones that blew up the economy in 2008. These were the safest, most boring investments on the planet. Backed by the full faith and credit of the United States of America. What could possibly go wrong? One word: duration. And that word is about to haunt your nightmares. Here's how bonds work, explained in a way that will actually make sense. When you buy a government bond, you're essentially lending money to the government. They pay you interest, and at the end of the bond's term you get your principal back. Simple enough. But here's the crucial detail. When interest rates in the broader economy go up, the value of existing bonds goes down. Why? Because if you bought a bond paying 1% interest and suddenly new bonds are paying 5% interest, who in their right mind would buy your 1% bond for full price? Nobody. Your bond just became worth less on the open market. SVB bought billions and billions of dollars worth of long-term bonds when interest rates were at historic lows. 10-year bonds, 15-year bonds. They locked up their customers' deposits in investments that wouldn't mature for a decade or more. And they did this because long-term bonds paid slightly higher interest rates than short-term bonds. It was a way to earn a little extra yield, a little extra profit for shareholders. On paper, it looked brilliant. What could go wrong? Interest rates had been falling for 40 years. The Fed had printed trillions of dollars during the pandemic. Surely rates would stay low forever. Lower for longer, that was the mantra that echoed through every boardroom on Wall Street. Greg Becker believed it. His management team believed it. The market believed it. The market was wrong. Now, here's what makes this story even more devastating. There was someone at SVB whose entire job was to anticipate exactly this kind of risk. Her name was Laura Izurieta. She was the chief risk officer, and in April 2022, she left the bank. The timing couldn't have been worse. April 2022 was exactly when the Federal Reserve began its most aggressive interest rate hiking campaign in 40 years. Inflation was raging. The Fed was determined to crush it, and rates that had sat near zero for years began rocketing upward. SVB's bond portfolio began hemorrhaging value. Those safe government bonds they'd bought, now worth billions less than what they'd paid. It was like watching a slow-motion car crash, except no one at SVB seemed to notice or care. 8 months. That's how long SVB went without a permanent chief risk officer during the exact window when interest rate risk was exploding. 8 months without anyone in the captain's chair specifically tasked with asking, what if everything we assumed about interest rates is wrong? But here's the truth. They don't want you to know. Even if Laura Izurieta had stayed, even if she had screamed warnings from the rooftop, there's no guarantee anyone would have listened. Because SVB's management was dealing with another problem, one that would prove equally catastrophic. The tech boom was over. By mid-2022, the party that had seemed endless was suddenly ending. The same forces that had created SVB's meteoric rise were now reversing with terrifying speed. Those venture capital firms that had been throwing money around like confetti, they were slamming their checkbooks shut. Tech valuations were cratering. Layoffs were sweeping through companies that had seemed invincible. And all those startups who had deposited their millions at SVB, they were now withdrawing that money to survive. Picture the scene, a founder who 18 months ago celebrated raising $50 million in funding. The champagne, the press release, the dreams of IPO glory. Now that same founder is staring at a spreadsheet calculating how many months of runway they have left. 12 months? 9 months? They need to cut costs. They need to pay salaries. They need to make payroll. And every dollar they spend comes out of their SVB account. This was the double squeeze that would kill Silicon Valley Bank. On one side, their deposits were shrinking as startups burned through their pandemic cash. On the other side, their bond portfolio was underwater by billions of dollars. If they sold those bonds to cover withdrawals, they'd have to book massive losses. If they held the bonds, they'd eventually be fine, but only if they could survive long enough for the bonds to mature. It was like a game of financial musical chairs, and SVB was about to discover there weren't enough chairs. Through 2022 and into early 22 and 23, the situation grew increasingly desperate. Deposits were draining steadily. The bond losses were mounting. And then came March 8, 2023, a Wednesday that will live in financial infamy. Someone at SVB made a decision that day. Maybe it was Greg Becker. Maybe it was the CFO. Maybe it was a communications team that catastrophically misjudged the situation. Whoever made the call, they decided to issue a press release. They decided to be transparent. They decided to tell the world what was happening. And in doing so, they lit the match that burned their bank to the ground. The announcement was straightforward in its devastation. SVB had sold $21 billion worth of securities at a loss of $1.8 billion. They needed to raise $2.25 billion in fresh capital to shore up their balance sheet. That's it. That's all it said. A loss, a capital raise, standard banking communication. But here's what SVB didn't understand. Timing is everything, and their timing could not have been worse. To understand what happened next, you need to understand how information moves in the world of technology startups. It doesn't move like it does in normal industries. It moves at the speed of light. There's a famous quote in Silicon Valley: information is shared horizontally before it moves vertically. What that means is that founders talk to each other before they talk to their boards. Investors share intelligence in private group chats. News spreads through WhatsApp groups and Twitter DMs and encrypted signal threads before it ever reaches mainstream media. When SBB's announcement hit on March 8th, it landed like a bomb in the most interconnected network of gossip on the planet. Within hours, the message was spreading through every venture capital firm, every startup accelerator, every tech company in America. And the message wasn't nuanced. It wasn't measured. It was simple and terrifying. Get your money out of SVB. Now, but here's the kicker. The people who moved first weren't random depositors. They were the most connected, most powerful players in Silicon Valley. They had access to information and networks that regular customers didn't have. And they weren't waiting to see how things played out. Peter Thiel, you know the name. PayPal co-founder, Facebook's first outside investor, billionaire, controversial figure. His venture capital firm, Founders Fund, was one of the first to send the alarm to their portfolio companies: move your deposits immediately. Get out of SVB while you still can. Was Thiel acting on legitimate concern, or was he lighting the match that would start a fire? This is one of those questions that still sparks debate today. Some credit him with saving his portfolio companies from catastrophe. Others blame him for triggering the panic that made catastrophe inevitable. The truth is probably somewhere in between. But here's the brutal reality. Whether Thiel was the cause or merely the catalyst, the bank run was now unstoppable. The digital wildfire had begun. March 9th, 2023. Thursday. A date that will be studied in business schools for generations. Picture this. It's early morning on the West Coast. Founders are waking up to phones that are already exploding with notifications. Email after email from investors. Slack messages marked urgent. Group chats with hundreds of messages from the overnight hours. The tone is frantic, desperate, survival mode. Are you out of SBB? Have you moved your money? I heard they're not going to open tomorrow. Someone at Redacted BC said their whole fund is pulling out. The rumors were running faster than any fact-checker could keep up. Some were true. Some were wildly exaggerated. But in a bank run, the truth doesn't matter. Perception is reality. And the perception was that Silicon Valley Bank was dead. Across America, and increasingly around the world, startup founders were logging into their SVB accounts. They were typing in wire transfer instructions with shaking hands. They were trying to move 6 months, 12 months, 18 months of runway to safer harbors. And they were discovering something terrifying. The system couldn't keep up. Think about that for a second. You have $5 million in your company's bank account. That money represents the salaries of your employees, the rent on your office, the servers that keep your product running. Your entire business depends on that money being accessible, and you're staring at a screen that says "System unavailable." The SVB mobile app crashed. The website slowed to a crawl. Wire transfers that normally took minutes were taking hours or not going through at all. The bank's infrastructure, built for normal daily operations, was being overwhelmed by a tidal wave of panic. One founder later described refreshing his banking app every 30 seconds for 6 straight hours. His finger hurt from tapping. His eyes burned from staring at the screen. The blue light of his iPhone felt like it was mocking him. Every time the page loaded, he held his breath. Every time it showed the same balance money he couldn't access. He felt sick. This is what a modern bank run looks like. Not crowds of people in suits pushing against teller windows. Not angry mobs throwing stones. It's thousands of desperate people, alone in their offices and homes and coffee shops, staring at frozen screens, feeling the nauseating certainty that their life's work is slipping away. The sounds weren't the roar of an angry crowd. The sounds were Slack notifications pinging, iPhones buzzing with texts, the frantic clicking of keyboards as people tried again and again to access their funds. In co-working spaces across San Francisco, you could hear the collective intake of breath when someone's transfer finally went through and the collective groan when the next person's failed. By mid-morning on March 9th, the numbers were becoming apocalyptic. Billions of dollars were leaving SVB every hour. The internal systems were flagging withdrawal requests faster than staff could process them. The bank that had spent 40 years building trust with the tech community was watching that trust evaporate in real time. Now you might be thinking, why didn't the government step in earlier? Why didn't regulators do something before it got this bad? This is where the story gets even more complicated. Because the regulators were watching, they were aware, but they were hamstrung by laws and procedures that were designed for a different era. Bank runs used to take weeks, sometimes months. When Washington Mutual collapsed in 2008, the largest bank failure in American history, it took 10 days for depositors to withdraw $16.7 billion. That gave regulators time to assess, time to plan, time to find buyers. SVB burned through that amount in less than 12 hours. The speed was unprecedented. The scale was unprecedented, and the concentrated nature of the depositors was unprecedented. This wasn't millions of small depositors each withdrawing a few $1,000s. This was thousands of companies each withdrawing millions. When a single startup moves $20 million, it matters a lot more than when 20 people move $1,000 each. And here's the statistic that should keep every bank regulator awake at night. 90% of SVB's deposits were uninsured. You probably know about FDIC insurance. The government guarantees your bank deposits up to $250,000. If your bank fails, you get that money back. It's been that way since the Great Depression, designed to prevent exactly the kind of panic that was now unfolding. But $250,000 is nothing for a company. A startup with 50 employees and modest salaries has a monthly payroll of at least $500,000. Larger companies have payrolls in the millions. They can't split their money across hundreds of banks to stay under the insurance limit. It's impractical. They need a banking partner who understands their business, so they concentrated their money at SVB. And that concentration meant that when panic struck, nearly everyone was uninsured. Everyone had everything to lose. Think about that math. If you have $250,000 in SVB and you're fully insured, what's your incentive to panic? You'll get your money back no matter what. You can wait for the dust to settle. But if you have $5 million and only $250,000 is insured, you just became the most motivated person on the planet to get that money out before everyone else does. You're in a race, and the losers get wiped out. This is the paradox of uninsured deposits. They make a bank look stable in good times, lots of money, but incredibly fragile in bad times. That money can vanish instantly. By Thursday afternoon, the mathematics of SVB's survival had become impossible. The bank needed liquidity cash to meet withdrawals, but their cash was locked up in bonds that were worth billions less than they'd paid. If they sold those bonds, they'd crystallize massive losses. If they didn't sell, they couldn't meet withdrawal requests. Greg Becker was on the phone with every major bank on Wall Street, desperately searching for a lifeline. Could someone buy SVB? Could someone inject capital? Could anyone help stop the bleeding? The answer again and again was no. No one wanted to catch a falling knife. No one wanted to inherit SVB's problems. And no one could move fast enough even if they'd wanted to. Meanwhile, the withdrawal requests kept piling up. By the end of trading on Thursday, customers had attempted to withdraw $42 billion. $42 billion, a number so large it's almost meaningless. Let me make it real for you. If you stacked 42 billion $1 bills, the pile would reach nearly 3,000 miles into space. You'd pass the International Space Station. You'd keep going into the void beyond. That's how much money was trying to flee Silicon Valley Bank on a single Thursday, $1 million per second for 42,000 seconds. That's almost 12 hours of non-stop hemorrhaging. And here's the detail that makes this story even more agonizing. Much of that money didn't actually leave. The systems couldn't process the requests fast enough. There were billions of dollars in pending transfers, stuck in digital limbo when the clock struck midnight. Those founders who had spent the day frantically trying to save their companies went to sleep not knowing if their transfers had gone through. They went to sleep not knowing if their money was safe. They went to sleep not knowing if they'd be able to pay their employees in the morning. Some of them didn't sleep at all. Friday, March 10th, 2023. The day Silicon Valley Bank died. The California morning was chilly that particular March cold that reminds you Northern California isn't actually a permanent summer. Outside the SVB headquarters in Santa Clara, a small crowd was gathering. But these weren't the Depression-era workers in overcoats and fedoras you've seen in history books. These were founders in Patagonia vests and Nike sneakers. They were VCs in Tesla cars that had pulled up to the curb. They were employees who'd driven in on autopilot, not quite believing what was happening. They were staring at the locked glass doors. And on those doors, taped up with what looked like hastily applied Scotch tape, was a piece of paper. The paper was from the FDIC, the Federal Deposit Insurance Corporation, the government agency that takes over when banks fail. And the paper said in cold bureaucratic language that Silicon Valley Bank was closed. Closed. The 17th largest bank in America. Closed. The bank that had survived the dot-com crash. The bank that had navigated the 2008 financial crisis. The bank that had tripled its deposits during the pandemic. Closed. It took regulators less than 48 hours from the initial announcement to pull the plug. In the history of American banking, no institution of SVB's size had ever failed so fast. It was the second largest bank failure in U.S. history. Only Washington Mutual was bigger, and WAMU had taken 10 days to die. SVB didn't even make it to the weekend. The small crowd outside the headquarters stood in stunned silence. Some were crying. Some were on their phones desperately calling lawyers and accountants. Some were just staring, trying to process the magnitude of what had just happened. One founder later described the feeling as surreal. He'd been a customer for 8 years. He'd celebrated raising his Series A at an SVB-sponsored event. He'd gotten his first line of credit from the bank when no one else would touch him. And now he was standing outside locked doors, wondering if he'd ever see his money again. Inside those doors, the scene was equally chaotic. FDIC officials were pouring in, trying to assess the damage. SVB employees, many of whom had stock in the bank that was now worthless, were being told to go home. Years of work, decades of careers, evaporating in a single morning, and across America, thousands of companies were waking up to a nightmare. Let me tell you about what happened when the payroll didn't clear. It's Friday morning. You're a junior software engineer at a startup in Austin, Texas. You've been with the company for 8 months. You love your job. You believe in the mission. And you just got a text from your CEO. Team, there's a problem with our banking. Your direct deposit may not hit today. We're working on it. Working on it. What does that mean? Your rent is due on Monday. You have student loans. You were planning to take your partner out for dinner this weekend. Suddenly, that text feels a lot more serious. Now imagine you're not just a single engineer. Imagine you're the CEO who has to send that text. One founder described the feeling as nauseating. He had $5 million in SVB on Thursday. On Friday, he couldn't access a single penny of it. And he had a payroll of $200,000 due that afternoon. 200 employees were counting on him. They had mortgages, they had kids, they had medical bills, and he had to tell them that he didn't know if he could pay them. This is the human cost of a bank run. It's not just numbers on a screen. It's real people with real lives who depend on that money for survival. For immigrant founders, the pain was even more acute. CBID had been famous for banking entrepreneurs who didn't have U.S. credit histories. Founders from India, from China, from Nigeria, from anywhere in the world who were trying to build the American dream. Other banks wouldn't touch them. SVB believed in them. One immigrant founder described SVB as feeling like a partner who understood our struggle. When the bank failed, he didn't just lose a financial institution. He lost the one American bank that had given him a chance, the one bank that had said yes when everyone else said no. These are the stories that got lost in the political noise that followed. The cable news debates about woke banking and tech bros getting what they deserve ignored the human reality. Thousands of regular workers, many of them immigrants, many of them living paycheck to paycheck despite working at startups, suddenly facing financial catastrophe. As Friday turned into Saturday, two parallel dramas were unfolding. The first drama was public. Gary Tan, the president of Y Combinator, the legendary startup accelerator that had launched companies like Airbnb, Dropbox, and Stripe, was sounding the alarm on every platform he could find. His message was apocalyptic. If the government didn't act, an entire generation of startups would be wiped out. Payroll wasn't just a matter of inconvenience, it was a matter of survival. Companies that couldn't pay employees would have to shut down. Employees who didn't get paid would face eviction, defaulted loans, destroyed credit. This is an extinction-level event for startups, Tan declared. And he wasn't exaggerating. Bill Ackman, the billionaire hedge fund manager, was tweeting up a storm. His argument was different but pointed in the same direction. If the government didn't guarantee all deposits, not just the insured ones, the panic would spread. Other regional banks would face runs. The contagion would be unstoppable. These tweets weren't just noise. They were part of a deliberate campaign to pressure the government into action. And whether you think that pressure was appropriate or not, it was effective. The second drama was private, and it was playing out in the highest levels of the U.S. government. Janet Yellen, the Treasury Secretary, was facing an impossible choice. The rules were clear. FDIC insurance covered $250,000 per depositor, period. If you had more than that and your bank failed, tough luck. That was the deal. That's what people had agreed to when they deposited their money. But the rules had never anticipated this situation. The rules assumed that uninsured depositors were sophisticated investors who understood the risks. The rules didn't account for what would happen when 90% of a bank's deposits were above the insurance limit. The rules didn't account for a bank run that happened in hours instead of weeks. If Yellen followed the rules, thousands of companies would fail. Hundreds of thousands of workers would be financially devastated, and this was the part that terrified policymakers. Other banks might face the same panic. What if depositors at First Republic Bank started running? What about Signature Bank? What about every regional bank in America? The fear of contagion was the trump card that SBB's advocates played again and again. This isn't about bailing out tech bros, they argued. This is about preventing a systemic collapse of the American banking system. Behind closed doors, Yellen was meeting with Federal Reserve officials and FDIC leaders. They had to make a decision before markets opened on Monday. They had to find a way to stop the bleeding without setting a precedent that rewarded reckless behavior. It was Saturday night. Sunday was coming, and the world's financial system hung in the balance. Here's where the story gets really interesting, because what happened next reveals something crucial about how power really works in America. The official version goes like this. Government officials acting in the public interest determined that SBB's failure posed systemic risk to the financial system. Under that designation, they were authorized to guarantee all deposits, even the uninsured ones, to prevent a broader panic. The money to pay back depositors would come from the Deposit Insurance Fund, which is funded by assessments on banks themselves. Taxpayers, the government emphasized, would not be on the hook. This is technically true, but here's the kicker. The Deposit Insurance Fund exists because the government mandates it. And if that fund were ever exhausted, Who do you think would backstop it? The federal government. Which means, ultimately, the taxpayers. So was this a bailout or not? The answer depends on your definitions and your politics. Some argued it was absolutely a bailout. The government broke its own rules to save depositors who should have known better. Those depositors chose to keep millions of dollars in a single bank, despite clear warnings that only 250,000 was insured. They made a bet, and when the bet went bad, the government rescued them. Others argued it was the responsible thing to do, the alternative letting thousands of companies fail, letting the panic spread to other banks, potentially triggering a 2008-style financial crisis would have cost far more than the intervention. Sometimes you have to break the rules to prevent catastrophe. What's undeniably true is this: the people who got saved were mostly wealthy, venture capitalists who had advised their portfolio companies to run for the exits, founders who had millions in the bank, tech workers at companies that even after the layoffs still paid six-figure salaries. The janitors and cafeteria workers at SVB? They lost their jobs. The small vendors who were owed money by startups that collapsed anyway? They got nothing. The intervention saved the depositors, but it didn't save everyone connected to the disaster. Sunday, March 12, 2023. The announcement came. Treasury, the Federal Reserve, and the FDIC jointly declared a systematic risk exception. All SBB depositors, every single one, would be made whole. Whether you had 250,000 or 250 million, you were getting your money back. The relief in Silicon Valley was palpable. Founders who had spent the weekend preparing bankruptcy filings deleted those documents. CEOs who had been dreading Monday morning calls with employees suddenly had good news to share. The existential crisis was over. But the questions were just beginning. Where was Greg Becker during all of this? The SVB CEO had been conspicuously absent during the public phase of the crisis. He hadn't gone on television to reassure customers. He hadn't held a town hall with employees. He seemed to have vanished. And then the leaks started. Becker, it turned out, had sold millions of dollars worth of SVB stock in the weeks before the collapse. The timing raised immediate suspicions. Did he know the bank was in trouble? Was he cashing out while encouraging customers to stay? Even more damaging was the imagery that emerged later. Reports surfaced that Becker was seen flying first class to his $3.1 million vacation cottage in Hawaii shortly after the bank's failure, while thousands of founders were scrambling to save their companies, while employees were losing their jobs. The CEO was apparently heading to his beach house. Was this a crime? That's for prosecutors to determine. But was it a devastating look for a leader who had spent years cultivating trust with the startup community? Absolutely. The Becker story became a symbol of everything that infuriates ordinary Americans about the financial elite. The rules apply to everyone except the people at the top. The captains of industry always seem to have parachutes when the plane goes down. The little people suffer while the executives escape. In the weeks and months that followed, the recriminations flew fast and furious. Congressional hearings were held. Fingers were pointed, reports were written, and the consensus that emerged was, frankly, damning. The Federal Reserve's own post-mortem was blunt. SVB failed due to textbook interest rate mismanagement. This wasn't exotic. This wasn't complicated. This was Banking 101, and SVB's management had failed the course. But here's what makes me angry about the coverage that followed. Some commentators tried to blame SVB's collapse on wokeness, on the bank's diversity and inclusion initiatives, on their support for environmental causes, on anything that could be spun into a culture war narrative. This is garbage. Complete and utter garbage. The Federal Reserve report didn't mention diversity programs. It didn't cite ESG investments. It cited the fact that SVB bet the bank on interest rates staying low forever, and they were catastrophically wrong. They didn't have adequate risk management. They didn't respond quickly enough to changing conditions. And when the crisis hit, they made it worse with a poorly timed press release. You know what doesn't cause a bank to fail? Hiring diverse employees. You know what does cause a bank to fail? buying billions of dollars of long-term bonds at the worst possible moment and then going 8 months without a chief risk officer. The attempt to politicize SVB's collapse was a distraction from the real lessons, and those lessons are terrifying. So what did we actually learn from Silicon Valley Bank? First, we learned that the rules of bank runs have fundamentally changed. In the age of mobile banking and instant communication, there is no such thing as a slow-motion crisis. What used to take weeks now takes hours. Regulators, designed for a previous era, are perpetually behind the curve. Second, we learned that safe investments can be deadly. Government bonds aren't risky in the traditional sense. You'll get your money back if you hold them to maturity. But if you have to sell them before maturity and interest rates have risen, you can face catastrophic losses. Duration risk is interest rate risk, and SVB didn't respect it. Third, we learned that concentration kills. When 90% of your deposits are uninsured and can flee at a moment's notice, you don't have a stable funding base. You have a powder keg waiting for a spark. Fourth, we learned that the too-big-to-fail problem hasn't been solved. It's been distributed. SVB wasn't a megabank. It wasn't J.P. Morgan or Bank of America. It was a mid-sized regional bank that had successfully lobbied for lighter regulation, and when it failed, the government still had to step in because the contagion risk was too severe. Fifth, and most importantly, we learned that the lessons of 2008 were already being forgotten. Let me tell you what keeps me up at night. SVB wasn't unique. There are other banks out there right now with similar profiles: concentrated depositor bases, underwater bond portfolios, inadequate risk management. Any one of them could face a run if the right spark hits. First Republic Bank collapsed a few weeks after SVB, despite frantic rescue attempts. Signature Bank went down the same weekend as SVB. The regional banking sector is under immense pressure, and the cracks are still forming. And here's the thing about bank runs. They're driven by psychology as much as by fundamentals. If people believe a bank is in trouble if they even slightly suspect it, they'll move their money just to be safe. And that movement can make the belief come true. We're living in an age where a single tweet can move markets, where group chats can coordinate panics, where information and misinformation travels faster than any regulator can respond. The safeguards we built after 2008 were designed for a world that no longer exists. The stress tests assumed bank runs would take time. The capital requirements assumed depositors would be patient. None of those assumptions hold in a world where you can move $1 million with a few taps on your phone. So what do we do about it? Some argue for more regulation, higher capital requirements, more frequent stress tests, stricter limits on interest rate risk. These would help, but they'd also make banking less profitable, which would push risk into the shadow banking sector where there's even less oversight. Some argue for better communication. If SVB had announced their capital raise differently, if they'd secured a buyer first, if they'd coordinated with regulators, if they'd managed the narrative better, maybe the panic could have been avoided. But this puts a lot of faith in corporate communications teams to navigate an environment where a single misstep is fatal. Some argue for reforming deposit insurance. Maybe the $250,000 limit is too low for the modern economy. Maybe commercial accounts should have different coverage than personal accounts. But raising insurance limits creates moral hazard. If all deposits are guaranteed, what incentive do depositors have to care about their bank's health? There are no easy answers, only trade-offs. If you're still watching, you're probably wondering, what should I do with this information? First, look at your own banking situation. Do you have more than $250,000 in any single bank? If so, you're taking the same risk that SVB's depositors took. Spread your money across multiple institutions. It's inconvenient, but it's safe. Second, understand that safe investments aren't always safe. The same interest rate dynamics that killed SVB affect your bond funds, your mortgage rates, your retirement accounts. Pay attention to what the Federal Reserve is doing. Those decisions ripple through everything. Third, be skeptical of confidence. Greg Becker was confident. His board was confident. His board was confident. The investors who kept their money at SVB were confident. Confidence killed them, and finance, a little paranoia is healthy. Fourth, remember that the system is more fragile than it appears. The fancy towers, the complex regulations, the serious people in suits, they create an illusion of permanence. But SVB proved that a 40-year-old institution can evaporate in 48 hours. Nothing is permanent. Not your bank, not your job, not the economic system we've built. Let me leave with a thought experiment. What if SVB had done things differently? What if instead of announcing their losses and capital raise in a press release, they had quietly secured a buyer first? What if Goldman Sachs or J.P. Morgan had agreed to acquire SVB before anyone knew there was a problem? The losses would have been absorbed. The depositors would never have panicked. You probably would never have heard of Silicon Valley Bank. What if Laura Izurieta had stayed? What if SVB's chief risk officer had been screaming warnings about interest rate risk in mid-2022 when there was still time to act? What if management had listened? What if the 2018 regulatory rollback had never happened? What if SVB had been subjected to the same stress tests as the biggest banks? Would the interest rate mismatch have been caught earlier? What if Peter Thiel hadn't advised his portfolio companies to pull their money? What if the first dominoes had never fallen? Would SVB have survived? These what-ifs aren't just academic exercises. They're reminders that history pivots on small decisions. A poorly worded press release, a risk officer who left at the wrong time, a tweet from a billionaire. The butterfly effects are everywhere. And they're reminders that the same butterfly effects are operating right now in banks and companies and government agencies that we trust with our futures. Somewhere, someone is making a decision that will determine whether you and I prosper or suffer. We'll never know about it until it's too late. So here's my challenge to you. Don't watch this video and then forget about it. Don't treat SVB's collapse as entertainment, a cool story to tell at parties. Use it. The next time you see a safe investment that seems to offer higher returns than it should, ask yourself, what's the catch? The next time you hear a CEO confidently proclaim that everything is fine, remember Greg Becker. The next time politicians argue for lighter regulation because the banks don't need it, remember what happened when SVB got what it lobbied for. The financial system runs on trust. But trust should be earned, not given freely, and the institutions that hold our money should be forced to prove every single day that they deserve it. $42 billion, 48 hours. The 17th largest bank in America. Gone. It happened once. It will happen again. The only question is whether we'll be ready. If you made it to the end of this video, you're clearly someone who cares about understanding how the world really works. That's rare, and that's valuable. Hit the subscribe button because next week we're diving into another story. They don't want you to know the inside story of the 2008 financial crisis told the way it's never been told before. You'll learn why the people who caused the crash never went to jail, why the bailouts were even bigger than you thought, and why the seeds of the next crisis were planted in the recovery. Leave a comment below. Where do you keep your money? And did this video make you reconsider? I read every single comment, and I want to know what you think. And if you know someone who still doesn't understand what happened to SVB, maybe a friend who thinks it was about woke banking, or doesn't understand why it matters, share this video with them. The truth is important, and the lessons are urgent, and the more people who understand what really happened, the better chance we have of preventing it from happening again. This was the story of Silicon Valley Bank, the fastest bank failure in American history. A cautionary tale for the digital age, and a warning about what's coming next. Until next time.